Research at City Markets Edition.
Welcome to the Research at City Markets Edition podcast, where we break down global macro in just under 10 minutes. I'm your host, Elise Badoy, Head of UK, Europe, the Middle East and Africa Research here at City. We're recording from London today, and I'm joined by Max Layton, City's Global Head of Commodities Research, and our usual host, Beata Manthey, who is City Head of European Equity Strategy. So today we are going to dive into what's been dominating headlines, the escalating conflict around Iran and the Middle East. We'll unpack in this podcast what's happening, what it means for oil, commodities, and global equity allocation, and where we think opportunities and vulnerabilities lie. So first, I'm going to turn to you, Max, to set the scene. Markets have been volatile. Oil has moved higher. Geopolitics feel unusually fluid. From your team's latest work, what are the big moving pieces?
So it's not just, I would say, oil moving higher, but it's also oil product prices and gas prices that have really responded to what's happened in the Middle East over the past couple of days. And more broadly, these markets, particularly the oil market, the oil product market, have been pricing risk over the last couple of months. So we've seen increases in total oil prices since the start of the year, whether you're looking at gasoline or diesel or jet fuel, in the vicinity of 35 to 50%. So really big moves in energy prices. Part of that is due to actual disruption, but most of it is a geopolitical risk premium.
And so obviously you've got a couple of scenarios that you have recently published. You've upgraded your near-term oil expectations meaningfully. Can you walk us through the probabilities here, base case, bear case?
Sure, yeah. So I'll walk you through some of the scenarios. Certainly our base case, this is a tricky environment to be forecasting, but we've got to have one. And the base case is essentially that we have further price increase in the very near term. I think the core of it is that the Iranian regime is facing an existential threat, and that with that, regional energy infrastructure and flows through the Hormuz Strait are at threat. They are at risk. And you're talking about a massive amount of oil production, exports, product production that is at risk right now, and we think at least for the next couple of days. One thing to look for to see a lower geopolitical risk premium and for that amount of oil at risk to go down is for the markets. It's basically around the market's perception and the real end to the missile and drone threat from Iran. So anything that can lead the market either to believe that drone threat, that missile threat to energy infrastructure in the region is peaking or about to peak or going down. There's multiple ways that the market may see that happening, but anything that leads to that will likely lead to a reduction in the oil price. Now, between now and then, the next couple of days, I think the market is highly at risk of major energy disruptions. And so, that's basically because there is still, so Pete Hegseth in a presentation earlier today mentioned that, Iran still has capabilities for long-range missiles. This threat still exists, and until it doesn't, there's going to be a really big geopolitical risk premium in the market. And there are multiple other ways, I would say, in our base case that there's major upside risks in the near term, but as time passes, we do see prices eventually moving back down. So our baseline view is that over the next 1 to 2 weeks, there are multiple paths for the international portion of this conflict to end. I won't go through them all because we don't have enough time, but there's multiple paths for this to end. And that would then reduce the oil at risk from all regional oil flows at risk within the Middle East to just the Iranian exports being at risk. And that's a massive reduction. You're talking about an 80-90% reduction in oil at risk in that situation. And that's our base case. And we do think that will happen over the next 1 to 2 weeks. That's the baseline view. And with that, oil prices should come back down eventually sometime in the second quarter, Brent down to around $70. big issue will be whether or not there's civil or domestic conflict. The future leadership of Iran is in question. How does it happen? There are more questions than answers. There's scenarios that result in domestic conflict that impacts oil exports. Even in that world, we think that China will reduce stockpiling. We think that OPEC will ramp up production over the course of 1 to 3 months, and we think they can pretty easily ramp up 1 to 1.5 million barrels and offset a lot of the loss, certainly of the crude oil from Iran, if it does happen. So there are some offsets in the system that can help to keep oil prices higher than where they were at the start of the year at 60, around $70 through the second quarter, even in the scenario that exports are impacted. I didn't really go through the bull or bear case, but I think we've covered a lot there already.
Max, thanks for outlining the scenarios, the various options. Perhaps just remind us of your base case just for our listeners today.
Sure. So near term, we see oil trading up above $80. It's been trading $75 to $80 Brent. We think it's going to be $80 to $90 over the coming week or so. And then we have it coming down into the second quarter to around $70 Brent. And then by the second half, we do see it returning to $62 as we do have the Russia-Ukraine as our base case, the deal on that front.
Thanks, Max. And oil is clearly central here. And I'd love to hear from Beata now. Obviously, oil being the mechanism of transmission from geopolitical risk to the economy, usually when we look at this type of crisis. Beata, let me bring you in. What are you seeing in the equity markets right now and what's ahead?
Hi, Elise. And correct, the transmission effect of geopolitical risks into equities is obviously oil prices. And historically, effects of these type of shocks have been actually short-lived, except a few more prolonged crises. And I have to say, today's stock market reaction or stock market performance has really followed this traditional playbook for higher geopolitical risk. So defensives and oil stocks up, cyclicals down, especially those with more energy-heavy industries. Globally, in terms of regions, best positioned to outperform in this type of scenarios tend to be the UK, and actually the US tends to be relatively more immune too. Most vulnerable, for obvious reasons, given dependencies on energy imports, is Japan and the continental Europe.
Thanks, Beata. Obviously, I would love to talk about inflation, because if oil stays elevated for a few weeks, and we're talking about all the questions being around the length of this situation rather than the situation itself, does this meaningfully change global inflation forecasts if it stays elevated for a few weeks? Max, first, perhaps?
Look, it certainly has the possibility to do that. It wouldn't be my base case. I mean, we certainly have oil price forecasts today, as of last night, that are higher than what we had a week ago. And that is because there is some disruption to oil supply, and that will impact the global market, global inventories over the next couple of months. And, there's likely to be more concern about Iranian exports than there otherwise would have been that we predicted a week ago. So, slightly higher oil prices through the course of the year in the baseline scenario. I'm not sure it's enough to really move the needle. On that note, I would say one of the most bearish things for oil, bearish things for inflation, will be peace deals going forward. So not just resolution in Iran that results in the free flow of the Iranian oil exports, but also Russia-Ukraine. So there was some really interesting comments by Ukraine's Budanov over the weekend about progress on the Ukraine talks. It is our baseline view that during the summer, perhaps the late summer, that you do get something of a Russia-Ukraine deal. And in that world, you can start thinking about a pretty significant global deflationary impulse coming from the energy space and bringing inflation closer to target in places like the US.
Thanks, Max. Beata?
So clearly that question on how the crisis or higher energy prices affect inflation and central banks, it keeps coming back to us. And I'll give you a rule of thumb from our economists, and that is for every 10% rise in Brent oil, headline inflation increases by around 25 basis points. And on the top of that, of course, you have moves in natural gas prices. So an additional 10% in TTF in natural gas prices adds another 10 basis points on inflation. Now, that only happens, this transmission mechanism, if the moves that we've been seeing today are sustained. So if they are, we could be getting a bit higher inflation, around 25, 35 basis points, higher Eurozone inflation over the next 12 to 15 months. So these are the risks, but the higher oil prices would need to stay here for longer periods of time.
Thanks, Beata. And obviously, as I'm sure Beata will confirm, important to watch how European cyclicals behave, because if they do hold up, it probably tells us that markets believe it's temporary and not structural. Our time is up now. Thank you, Max, and thank you, Beata. Thank you for joining us today if you were listening. This episode was recorded on the 2nd of March, 2026. I'm your host, Elise Badoy. If you enjoyed the podcast, please leave us a review on your favorite podcast platform. Our next Research at City Markets edition will be hosted by Dirk Willer, City Global Head of Macro Strategy and Asset Allocation. And be sure to look out for our Research at City podcast, which you can access on the same channels. Thanks for tuning in. Goodbye for now.
This podcast contains thematic content and is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information, and although obtained from sources believed by Citi to be reliable, its accuracy and completeness are not guaranteed. Past performance is not a guarantee or indication of future results. This podcast may not be copied or distributed, in whole or in part, without the express written consent of Citi. Copyright 2026 Citigroup Global Markets, Inc. Member SIPC. All rights reserved. Citi and Citi and Arc Design are trademarks and service marks of Citigroup Inc. or its affiliates and are used and registered throughout the world.